What is sources of funds? So, according to our research, sources of funds means the origin of the funds involved in a business relationship or occasional transaction. It includes both the activity that generated the funds used in the business relationship. For example, the customer's salary as well as the means through which the customer's funds were transferred. There are three types of need for funds. These are: first, to start a business as initial expenditure; second, to fund continuous business activities and money flowing; third, to expand the business.
Sources of fund includes the internal sources, which is composed of profit, depreciation, and sales of asset. On the other hand, we also have the external sources, which is composed of long-term or share capital and loan capital, and short-term, which is overdraft or leasing, etc. Internal sources of finance refer to fundraising options that exist within the business itself. This includes all your day-to-day profit-boosting operation, such as the sale of stock or services. It can also involve the sale of business asset, which is a particularly important option when you are considering altering and direction of your business or you're looking into option for downsizing.
Profit is the positive amount remaining after subtracting expenses incurred from the revenues generated over a designated period of time. Depreciation refers to an accounting method used to allocate the cost of a tangible or physical asset over its useful life. Depreciation represents how much of an asset value has been used. It allows companies to earn revenue from the assets they own by paying for them over a certain period of time.
Asset sales is the purchase of individual assets and liabilities, whereas a stock sale is the purchase of the owner's share of corporation. External source of finance are those that came from outside your business. This can mean money that comes from loans or investor through stocks and share, as well as lines of credits that can be opened with banks or financial institutions.
Long term can be defined as any financial instrument with maturity exceeding 1 year, such as bank loans, bonds, leasing, and other forms of debt finance, and public and private equity instrument. Share capital. The most important source of funds for a limited company, it is often considered as permanent capital as it is not by the business, but the shareholder can have in the profit called dividend.
The three types of shares are ordinary shares, preference shares, and deferred shares. Ordinary shares are the most common types of shares and the most riskiest shares. Dividend depend on the profit of firm, but all ordinary shareholders have voting rights. Preference shares. The share owners receive a fixed rate of return. They carry less risk than ordinary shareholders, but they are not strictly owners of the company. Deferred shares. These shares are often held by the founders of the company. Deferred shareholders only receive the dividend after the ordinary shareholders have been paid. Loan capital. Any money which is borrowed for a long period of time by a business is called loan capital. Types of shares are debentures, bank loans and mortgages. Merchants are investments. Governments are EU and grants. Debentures are the fixed rate of the return, first to be paid. Bank loans and mortgages is suitable for small to medium-sized firms which property or some other assets act as security for the loan. Merchants or investment banks acts on behalf of clients to organize and underwrite raising finance. Governments or EU may offer loans in certain circumstances.
Short-term are debt funds that lend to companies for a period of 1 to 3 years. These funds mostly take exposure only in quality companies that have proven record of repaying their loans on time as well as have sufficient cash flows from their business operations to justify the borrowing. Bank loans. Bank loans are loans that requires a rigid agreement between the borrower and the banks. Overdraft facilities. Overdraft facilities are short-term financing from banks. Leasing. Leasing provides the opportunity to secure the use of capital without ownership, effectively a hire agreement.